I'm joined from Dubai by Bhavik Minta, Chief Market Analyst at Century Financial. Thank you so much, Mr. Minta. Welcome to the show. This is the first time we hear this tone about the bond market and reading into it, and that there is risk and opportunities based on the risk or entering the 2 or 10 year. So, do you agree with this kind of language in terms of this market?
If we look at the latest, the FOMC the meeting that took place last week, it is very clear that they are not going to suddenly cut the rates and sound very dovish. If at all, the expectations are higher for longer. So the Fed Chair Powell has been absolutely hawkish. He has been very clear that he is not going to call it a victory as far as the inflation is concerned. Uh, the reaction to that particular meeting, we had the 2 years touching almost 2 decades high, above 5.1%, even the 10-year yields rallying to 4.5%. So majority of the market consensus is pointing towards a big opportunity towards the shorter term of the yield curve, wherein people are trying, the US institutional investors are trying to move the money away from the cash to the money market funds that are investing in a shorter term 2 to 3 year duration. What this goes on to say is, should there be actually a scenario where a rise in oil prices actually causes a stagflation kind of thing, we might see Fed actually announcing a big rate cut kind of thing, which will in turn cause a huge rally in 2 year bonds, thereby decreasing the yields. So this is where all the opportunities are currently lying, towards the shorter tenor of the yield curve.
With those expectations of higher yields, what do we expect for the dollar move and the gains on the dollar until year end?
The ECB meeting that was held recently, as well as the Fed meeting that was held last week, there seems to be some kind of divergence, because ECB is trying to sound more dovish, announcing that there's not going to be any more rate hikes. They will wait for the data, the oil markets and all. But the communication from Powell and the team has been pretty clear that they are still not calling it a victory. So I feel dollar has more legs to run, more amount of rally for the dollar as compared to euro. Technically, we are eyeing the support zone of 1.045 to 1.05, a drop below which will be very precarious for the euro.
Higher yields has an inverse relationship with gold. Where do you see gold by year end?
Gold most likely is going to remain under the pressure because of a stronger rally in US dollars. And as you've rightly highlighted, yields tend to have an inverse correlation with the gold. So, as long as you do not see a scenario where the central banks have declared victory as far as the inflation fighting is concerned, gold is likely to stay under pressure, and we are eyeing lower targets even near to the 1700 level zone.
Bhavik, in terms of the declines in the last few sessions, is it a correction and we'll see a deeper correction later, or is it a correction that will be followed by an upward trend in the stock markets?
In all likelihoods, I would say the markets were turning very complacent as far as pricing in what the FOMC or the J Powell was going to speak. But if you look at the movement markets that has happened post Wednesday night and even the Thursday's downfall, I think this could be a new leg down. Should the FOMC speeches again be towards the hawkish side? So to expect a big amount of again pullback from this levels would be a bit of an overstatement, because the mandate that the Fed has been given, they are very clear on that thing. Unless and until they do not see a big softening in the labor market numbers, we do not see a big pullback in the equity prices.
Will there be a bet on technology related to AI?
That bubble is already being played in the markets. So stock like Nvidia, which is still up by 175 to 200%, Look at even what's happening with the Tesla when it announced the plans of launching its own Dojo supercomputer. So major analysts are again repricing what the Tesla price targets are. The AI bubble is terrible, is still very much alive in the markets. It's still being played out. Unfortunately, for the market participants, the US economy is not actually just the tech sector, but the way these US indices rally, it's just the seven stocks that are leading the entire movement.
Bhavik, Mitta, thank you so much.
Thank
I'm
you.
Jonas from Central Financial. Have a nice day.
Thank you.
Thank you so much.